Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the Nasdaq Market Desk this afternoon, we have George Catrambone. He's head of fixed income at DWS Group, as well as Chris Dearborn and Max Cabasso, managing directors on the Nasdaq Market Intelligence Desk. We're here to discuss where we are in the late cycle and if getting longer and the impact to fixed income. It's great to have you guys with us. Welcome to Trade Talks. And George, last time we spoke, we were thinking about 6 rate cuts happening in 2024. We certainly, we're not going to get there in 2024.
No.
So,
well, we don't think.
Well, we don't think so. I mean, wait, actually, let's count.
Maybe 6 hikes, 6 more hikes. That would be fun.
So,
right?
Yeah, I mean, it feels like we're kind of at the end of cycle, late cycle, but the dynamics continue to keep getting longer.
And I think that large backup in rates we saw actually the Fed a favor. If you look at the data where we came in Q1 with CPI, strong print after strong print, 3 prints makes a trend. Yeah. I don't think that the Powell or the Fed is too upset about seeing the front end back up in rates near 80 basis points to 5% to start to tighten financial conditions a little bit and try to put the toothpaste back in the tube. I think for those that had that irrational exuberance and euphoria in Q4 and raised a lot of debt and kind of lend and pretend, as we talked about last time, as related to CRE, that's where I think the risk asset resistance starts to apply if we stay here forever. So I think this is still a potential soft landing scenario, but it gets narrow because they're going to have to tightrope walk that to conclusion, which is we land the plane, inflation continues to come down, and you don't wreck the economy in the process.
Right. And Chris, that's really the question we've been asking ourselves. Do you really want that 25 basis rate cut, or do you want a stronger economy, right? That's what you have to weigh out.
It's kind of interesting, right? Because you're finally starting to see some of the data talk about and look at the consumer. And the consumer's spending is starting to slow a little bit, confidence starting to slow a little bit. GDP flash print was a little bit weaker.
1.6.
Yeah, exactly. And then you have the issuers. So the issuers are talking about forward, they're doing fine on top line, most of them, but they're talking about softness across the board. And when you look at the consumer names, it's not just one sector. You're talking about restaurants, you're talking with a trade down, you're talking about this, staples with lower end consumers struggling there on price points. You're talking about athleisure, you're talking about beauty, all getting hit on the earnings prints based on the comments that they're making, kind of the forecast for what's going on this year. So what you're looking at, so historical data is not terrible, but starting to kind of fit the narrative. I mean, I think Barkin had a comment the other day. What did he say? Whiplash to the economic data, right? So it's not really sure what's there, but what is certain is that it's starting to slow down, which is what they want to do. They just don't want to slow it enough to cause a recession, right? Mm-hmm. And that's, I think, where we are right now.
And George, you bring up a great point in your notes here that the inflation rate of change, it doesn't really reflect on Main Street. And by the way, election polling finds the economy the #1 issue, despite the fact that the market's sitting at near all-time highs, right? So there's a big disconnect there.
And that polling doesn't matter the age or the demographic. Mm-hmm. They all, rightly so, look back at what it was 4 years ago for a gallon of milk or half a gallon of milk, and now it's $7.26. And they're much less fussed about travel and leisure, accounting for X or Y to the overall rate of change. It's the consumer sitting at home saying, wow, my floating rate, my credit card debt, these interest rate sensitive parts of the economy are starting to become a little bit of a burden for me. And I think you're starting to see that reflected in the polling. I don't think you've seen the data yet because of how much stimulus went into the economy overall. But I think to your point, that's why I don't think we're talking as much about hikes as we are cuts. When I look at real rates and other restrictive parts of the economy, we can't stay on this path forever. It is sufficiently restrictive. That's the Fed's backdrop. And I think you'll continue to see that consumer start to go slower and slower and slower.
But are corporates using higher inflation as a means to raise prices because they have to, obviously worry about their margins?
Sure.
And, not every consumer understands that nuance there, right? It's maybe not an inflation problem. Producer prices haven't gone up, right? But the margins have to expand.
It's only a problem. It's not a problem so long as either earnings or average hourly earnings and unemployment keeps up or lack thereof with the prices you're trying to push through. I think it becomes a problem when the consumer can't keep up. And I think non-farm payroll is a good example where we may start to see a little bit of that slowing. Travel and leisure, the fever finally broke. And you saw that was a much smaller component of overall job ads. I think now we're looking at government services and healthcare as half of those ads. And that, to me, doesn't signal a lot of healthiness in the areas I'm anchoring on to keep this march higher.
And Chris, you had talked about it, I think it was last week, about the consumer trading down, kind of going down a level because those prices have continued to go up and wages potentially haven't, kept up with it. Unemployment hasn't really kept up. in terms of being, affordability. So you're seeing consumers starting to kind of step down what they're going to spend on. Obviously, like we talked about, travel and leisure, but even with food in that sector, going out to eat versus in, you're seeing that kind of step below into kind of a tier down as it's starting to weigh more and people are getting a bit more conscious of their spending. He said there's been so much money, flooded into the economy. It still has, it's not going to work its way through after, 2 years. The sheer number, the sheer amount has gone, it was just so much. There's obviously still a ton of money sitting in money markets. So there's money out there to be used, but no one's ready to put it to work yet. Even though you might want to, and you might be smart to kind of lock in, 5% on a 2-year versus, 4.5%, 5% on a money market when that starts to turn. There's money out there, but again, it's going to take a while, I think, to continue to read through to the broader economy, and it's where we're at now.
And don't get lost so much in the catch-up areas like the revenge travel or like auto insurance catch-ups as part of overall CPI. Look at large durable good orders, which are slowing. Look out and see how many people are going and buying a large house. Look at a large auto purchase that's happening. Those are starting to slow. And I think those lagging areas will run out of steam. And the Fed recognizes that, or at least is hoping at this point.
But the whole thing is, Chris, we've spoken about this before a number of times. Even if they were to take it down 25 basis points, 50 basis points, if we're lucky this year, it's not going to change the fact that insurance has gone up 22 to 25% year over year. The Fed is not setting prices for that, right? And even if you get a quarter or half a cut, is it going to really move the housing market that much, 25 basis points?
I hope supply continues to come on. Right. Yes, I think there's a mountain of people that are either waiting for the cut to come in. Right. That's where I think you have a problem because every single asset class you talk to, whether it's equities, whether it's fixed income, whether it's CRE or even first time, everyone is waiting for this first cut or cuts to follow to start to move. And I think housing supply is a large challenge right now that, as perverse as it sounds, actually a cut or two may ease things enough to actually get the supply back online again.
Well, it's psychology versus affordability.
Yep.
To my point, 25 basis points isn't going to bring your mortgage down $1,000.
Also, obviously it's certain pockets of the country you're seeing that supply, but the difference, I was reading about the difference between this year, even last year versus 2008. There's no forced selling. So whereas you got that forced selling, 15 years ago, 16 years in 2008, people are just kind of sitting and waiting because they're sitting at 3%. Now there's a new proposition from Fannie for second lien mortgages. They can come in where you can get a second mortgage and it basically keeps the same rate as your original one. So if you're sitting on a 3%, you can borrow at that same 3% rate, even if it's there. So potentially even more money coming out. So again, if you're not forced to sell, you might not even have prices come down, even supply comes out, because if somebody's sitting there, okay, I'm just going to sit here, this is my price. If you hit my price, you want to lift it, go for it, but I'm not going to cut my price. I don't have to. My mortgage is affordable. I don't need to sell. So you're not seeing that housing price come down. You're not really seeing it with rents. Obviously, it's a lag indicator, but that's something to keep an eye on. If they unlock that, if Fannie Mae gets that proposal through, it's even more money coming into the system, being able to borrow against it again at artificially, essentially lower rates.
Think we'll see mortgage assumptions come back again?
I think so, very much so.
Yeah.
What's interesting with Max about the whole item here is that the consumer is very stuck on absolute price across all items right now. The sticker shock is continuing to move, but now it's coming back up. You're starting to see credit card delinquencies tick up to higher levels. Auto loans are starting to come around and people can't afford to pay them. So where that next group of home buyers is going to come from can't afford that right now. They're living within their means, and that's why we're seeing the trade down from the restaurants, you can picture the names, are you going to buy a $7 latte or are you going to make coffee at home? Am I going to be going to one of the beauty stores here in Times Square, or am I going to go to the local drugstore and get the discount brand? So there's the haves and the have-nots. But when you talk about the larger ticket items, which are the big things, one of the people I was talking to, one of the car companies, and some of their dealerships, April's usually a boon month for dealerships, especially in the Northeast when spring starts to change. One of the luxury auto dealers saw only 3 units move for the entire month of April. 3. And, and if you go back historically, even back, you take out 2020 as the anomaly, pre and post, that number is dozen to almost 30. And that's what's going on right now. People are not stepping up and paying that because they're still struggling with the absolute price points of the other items that they need. And that's the broader issue here when you talk about the consumer. Can the issuers shove more price increases down their throat? We get PPI next week before CPI. We'll get a good idea of how that worked out in March. From what I'm hearing from the issuers, that's going to be an interesting print.
Also hearing it in some of the guidance from some of the listed companies when they report earnings, specifically in kind of information technology, security systems. They were expecting a lot of the prints basically were expected to be beat and raise and a good size raise for the back half of the year. And a lot of them have actually kind of kept it status quo, and that's why you're seeing them trade down. They've kind of kept the status quo because the data that they're getting through their systems is mixed right now. It's a bit cloudier. It's not like it was a couple of years ago where they started to see things and say, okay, something is not right here. But they're starting to see stuff in the back end where they're not confident to go out and raise their guidance like everybody thought they were, because of the data that they're seeing internally that something's just not right. Things are starting to slow down. They're kind of keeping it status. They're biting the bullet this year, and if they get that raise and beat again later in the year, great, but they're not nearly as confident as they were even last quarter, kind of what they were projecting out for a year. Things are starting to kind of slow down with what they're seeing internally, and again, that back half of the year, everybody thought was going to be a big pickup. They're not that confident anymore than they were, again, just 6 months ago.
So George, from an investment perspective and the impact to the fixed income space, how are you thinking about portfolio positioning?
Absolutely. Based on those two narratives, you want to stay up in quality, quite frankly.
Right.
Yes, you recognize that spreads are tight right now, but you also recognize all-in yields, above 5% are quite attractive. And also you want to be careful that there's not complacency with $6.5 trillion or so in assets and money market funds, that you don't get too front-end loaded. You do want to start to take the opportunity. I know it's painful, right? Especially in times when rates are starting to back up, and I think the market has actually been playing the traders this year instead of the other way around. And how many times the boat has become kind of top heavy, right? Cuts, hikes, where are we going? So I think you really want to pay attention to starting to push out and extend duration. You want to think about treasuries and all-in yields. I would not be reaching for triple C yields at this point in time. I would not be surprised to see decompression happening. You had double Bs trading the same as single Bs in that space for a while. I would expect to start to see some stress come through to the individual companies and start to see the tide go out a little bit.
Meaning that they can't service their debt?
It could be. I mean, look, you have a refunding coming up, not just for the U.S. government and having to issue, bills and notes throughout the year and next. You also have, a high yield and floating rate segment of the corporate market that has to issue as well and continue to issue going into a debt wall in 25. So yeah.
Yeah, that's what we were talking about. A few months ago, the companies we were speaking to, kind of what everybody was looking for. Once we kind of got a signal that, all right, cuts are coming, companies are okay, we'll lock in something for that short term. We'll get things going, we'll make it through the next year, 2 years. Short-term cash, what do we need? Let's get that done. And then when rates started to come down, all right, then we're going to, go something bigger. We'll lock in something, at a lower rate. So that wall is now coming up again. Okay, that year potentially has happened. We thought rates are going to be coming down. Now we're going to have to redo this again. If you're not in as good a position, what those rates you're going to have to be paying on your debt, to lock in that cash, unless you're going to issue stock. So again, the expectation was potentially that we'd have kind of lower rates already at this point. Again, we're at 6 cuts just 5 months ago.
I think you had the 10-year here.
I got HYG, so
HYG.
the high yield. You can see it.
We prefer HYLB for those keeping track at home.
There you go.
Figure here, but you could see high yield is trading up, above their highs. This is a 5-year chart. We're above 52-week highs now. Again, we're basically flat today, but breaking out. So they've been getting that support. It's like you were talking about. Are you comfortable there with those yields, with the backdrop of, okay, we're going to have to go refinance, get new debt at higher rates? You're paying up for something that's kind of potentially not as
Well, do you think that's why there's somewhat of a lag in the mortgage market as well, where people are afraid to go out there with, okay, if I'm at 7% now, it'll be 5.5% by the end of 2024, and that didn't happen?
Certainly waiting for that, but I think that's part of it. The average mortgage in the U.S. is about 3.8%, with what, a half-life of 7 years?
Right.
So it would take a while, to your question earlier, whether they came down 25 basis points or not, you need to start to spring back on some of that supply. Otherwise, you're going to have that logjam, as you said, and not enough to actually move supply and get equilibrium back in.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.